If you worked from home last year and didn't claim the home office deduction, the IRS just kept your money. We're talking about an average of $4,200 that freelancers and self-employed workers leave on the table every single year. Not because the rules are complicated, not because they don't qualify, but because nobody explained it to them correctly. In the next 12 minutes, I'm going to show you exactly how the home office deduction works, who actually qualifies, the two methods the IRS accepts, and the number one mistake that gets people audited. This is Clause and Coin, legal moves that protect your money, explained in plain English. Here's what usually happens. You're a freelancer, you work from your bedroom, your living room, maybe a dedicated room you set up as an office, you pay rent or a mortgage, you pay electricity, internet, insurance, all of that every month to run your business, and then tax season comes. You open TurboTax or hand everything to your accountant, and somewhere along the way, the home office deduction either doesn't get claimed or it gets claimed wrong. Why does this happen? 3 reasons. First, most people think they don't qualify. They hear home office and picture a formal room with a mahogany desk and a nameplate. The IRS doesn't care about mahogany. They care about 2 things and 2 things only. We'll get to those in a minute. Second, even people who know they qualify often use the wrong calculation method. The IRS gives you 2 options. One is faster, but gives you less money. The other takes 20 more minutes and can be worth thousands of dollars more. Most people default to the fast one without knowing there's a better option. Third, people are scared of audits. There's a myth that claiming the home office deduction is an automatic red flag for the IRS. That myth is costing you money. We'll address it directly later in this video, so let's fix all 3 right now. The IRS has 2 requirements for the home office deduction. Both must be true. Requirement 1, regular and exclusive use. The space you're claiming must be used regularly and exclusively for business. That means if you work at your kitchen table, that table doesn't qualify, because you also eat there. But if you have a room, a corner, or even a clearly defined area that you use only for work, that can qualify. The word exclusively trips people up. It does not mean you need a separate room with a door. The IRS accepts a clearly defined portion of a room. A desk in the corner of your bedroom that is only used for work counts. What doesn't count is the couch where you sometimes check email. Requirement 2, principal place of business. Your home must be your main place of business. If you're a freelancer who works entirely from home, you meet this requirement automatically. If you also rent office space and work there most of the time, this gets more complicated, but for most people watching this video, you qualify. Write this down. Regular use, exclusive use, principal place of business. That's the entire qualification test. Once you qualify, you choose how to calculate your deduction. The IRS gives you 2 methods. Method 1 is the simplified method. You multiply the square footage of your home office by $5. That's it. Maximum deduction, 300 square feet, so maximum $1,500. Method 2 is the regular method. You calculate the actual expenses of your home, rent or mortgage interest, utilities, insurance, repairs, depreciation, and multiply by the percentage of your home that the office represents. And here's an example with real numbers. Say your home office is 200 square feet. Your total home is 1,000 square feet. That means your office is 20% of your home. Your annual home expenses, rent $18,000, electricity $1,800, internet $600, renter's insurance $300. Total $20,700. 20% of $20,700 is $4,180. With the simplified method, you'd claim $1,000. With the regular method, you'd claim $4,140. That's a difference of $3,140 in deductions, which at a 25% effective tax rate means $785 more money in your pocket. That's why the calculation method matters. And that's why defaulting to the fast option without doing the math first is one of the most expensive mistakes a freelancer can make. The only time the simplified method makes more sense is when your actual home expenses are very low, which is rare. People believe that claiming the home office deduction triggers an IRS audit. This is false. with one important caveat. The IRS audits home office deductions when they are disproportionate to income. If you made $30,000 last year and you're claiming $25,000 in home office expenses, that's a red flag. But a legitimate proportional home office deduction calculated correctly is not an audit trigger. What does trigger audits is claiming 100% of your rent as a business expense, or claiming a home office deduction while also having a separate rented office that you use as your primary workspace. Those are inconsistencies the IRS looks for. Claim it correctly, document it properly, and the deduction is completely safe. The IRS requires you to be able to prove your deduction if audited. Here's what to keep on file: a floor plan or sketch showing the dimensions of your home and your home office, photos of the space showing it's used exclusively for work, all receipts for home expenses, rent payments, utility bills, insurance statements, your calculation showing how you arrived at the percentage. Keep these in a folder, digital or physical, labeled by tax year. If you're ever audited, you hand this over and the conversation is over in 5 minutes. Let me give you a real example of how this plays out. A graphic designer, we'll call her Sarah, had been freelancing for 3 years, working from a dedicated room in her apartment. She knew about the home office deduction, but had never claimed it because her accountant told her it's not worth the hassle. In year 4, she switched accountants. The new one ran the numbers using the regular method. Sarah's apartment was 900 square feet. Her office was 150 square feet, 16.7% of her total space. Her annual housing costs, $24,000 in rent, $2,400 in utilities, $480 in renter's insurance. Total, $26,880. 16.7% of $26,880 is $4,488. Sarah had been leaving $4,488 in deductions unclaimed every year for 3 years. At her effective tax rate of 24%, that's $1,077 per year, or $3,231 over 3 years. That went to the IRS instead of staying in her pocket. The accountant who told her it's not worth the hassle cost her over $3,000. The lesson is not that accountants are bad. The lesson is that you need to understand your own deductions well enough to ask the right questions. That's exactly what this channel is for. Let's bring this home with the numbers. The average freelancer working from a dedicated home office qualifies for between $2,800 and $6,500 in home office deductions per year, depending on location and home size. At an average effective tax rate of 22%, that translates to between $616 and $1,430 in actual tax savings annually. If you've been freelancing for 3 years without claiming this deduction, you've potentially overpaid the IRS by $1,800 to $4,300. Here's your one-line action for this week. Measure your home office, measure your total home square footage, and run the regular method calculation before you file. If you haven't filed yet this year, do it now. If you already filed, you can amend your return for up to 3 prior years using Form 1040-X. The link to Form 1040-X is in the description, along with a link to the IRS official home office deduction rules so you can verify everything I said directly from the source. If you want help setting up your business structure correctly from the start, whether that's an LLC, an S-Corp, or something else, I've put a link to Law Depot in the description. It's what I recommend for freelancers who want to protect their income without paying attorney fees. If this video saved you money, subscribe. Next week, I'm covering IRS audit red flags for self-employed workers, the specific things that actually get freelancers flagged and the ones that are just myths. That's a video worth knowing before you file. This is Claws and Coin. See you next week.